key point is that Japan was not singled out because of weak data, but because fiscal and rate dynamics became impossible to ignore. Understanding this distinction is critical. Today was not about panic or deterioration, but about priority. Fiscal conditions and interest rates moved to the top of the list, and equities adjusted accordingly. This sets the context for the rest of the week, where the market's attention will remain sensitive to signals that either reinforce or relieve these concerns. To understand what was actually tested in today's session, it is important to look beyond the equity index itself and focus on where pressure truly emerged. Today was not a broad test of Japan's growth outlook, nor was it a reassessment of corporate profitability. Instead, the market tested Japan's tolerance for rising fiscal expectations and higher interest rates. This distinction matters because it frames today's move as a macro stress test rather than a cyclical downturn. The first element under examination was fiscal credibility. Ongoing discussion around political timing, potential stimulus measures, and fiscal expansion brought government financing back into focus. While none of these developments were new on their own, their accumulation shifted attention toward the sustainability of public finances. Markets tend to ignore fiscal issues for long periods until they suddenly do not. Today suggested that investors are beginning to price fiscal considerations more explicitly, especially through the bond market. The second element tested was interest rate sensitivity. Rising yields, particularly at the longer end of the curve, acted as the transmission mechanism between fiscal concerns and equity pricing. Higher long-term yields increase the discount rate applied to future earnings and alter relative asset attractiveness. Even without an immediate change in policy rates, expectations alone can tighten financial conditions. Today's equity weakness reflected this adjustment. It was not a reaction to weaker earnings expectations, but to a changing rate environment. The third element tested was investor confidence in policy management. Markets were effectively asking whether fiscal expansion, political uncertainty, and monetary normalization can coexist without creating instability. This is a nuanced question, and markets rarely answer it decisively in a single session. Instead, they probe gradually, adjusting positions and observing responses across asset classes. Today's cautious repricing suggests that investors were not comfortable ignoring these risks, even if they were not yet ready to assume a worst-case outcome. Importantly, today did not test the resilience of domestic demand or corporate balance sheets.